working so hard and we don't preserve the wealth after working so hard. So let's do that if you guys don't mind. We'll start by 10 past 6, 3 minutes to go. Yeah, in the meantime. Yeah, Bruno, do you have anything to say in the meantime while we're still waiting for?
Look, I think the importance of the data speaks for itself. The whole purpose of these group consultations is to allow for a level of engagement, which isn't always possible. I mean, there is Q&A, there is going to be a scenario playing, but I mean, to the greatest degree, this gives us a high representative value on, the problems that people are experiencing. And the questions are simple, but it's our job is to interpret the answers, and we're able to do that just by these few simple questions. We know where to focus the conversation. So yeah, it's guys, just in the next 2 minutes, fill both the survey so we know more about you, and the polls are specifically for my benefit. So when, specifically for mine and Shitty Boy's benefit. So when we're speaking, we can address certain aspects and certain issues.
Yeah, I think you're loud and clear. Thank you. And is it someone sending me something? Okay, my properties are registered in a CC. How do I complete the poll? Okay, let me see what's happening here. Okay. Okay, I think I see Kimesh. Is it Mr. Patel? You asked those, can you answer those questions? I think your question will be answered in a survey. Complete the survey, you'll see that it will actually assist us a lot. You'll be able to answer that, your situation, because you're saying your properties are in a CC. So yeah, do that for us. Then in that survey that I'm talking about, on the link on the chat box, you'll be able to to fill that information, and we'll be able to guide you, because effectively I assume that you're owning the interest in the CC in your personal name, which is something that we also going to cover. 1 minute to go. The guys that hasn't completed the polls, please do so. And then also there's a the survey on the chat box. Please do that. So please do that. And then it will be very nice. The beauty about having a small group like this is that each and everyone will be able to ask a question. And if you're shy, I'm gonna be that hardline teacher who's gonna pick on you, because the intention here is to help you to preserve your wealth. So I wanna make sure that by the time we leave here, everyone is taking advantage of having a group, having a one-on-one consultation with us, and we're able to solve your own personal, because some of the things might be so private that you don't wanna speak about here, and you're more than welcome now to have one-on-one discussion with us. So what we're going to do is 10 past 6. So how we're going to do, we're going to run you guys through the case study on one of the case studies that we have done. And it's gonna take about maybe 10 minutes, I think so, Bruno. And then upon that, then we're gonna have a discussion. We're just trying to create a base, so that, and at least there's some sort of a base from where this discussion. Do you wanna, I mean, let me make you a host. I think I can.
Please. So what I need, so I see in the group chat, there's 2 messages that they can't see the link for the survey.
Okay.
So I think let's just put that link on the group chat, and then I also just need the poll results, so I can start looking at it as well.
Okay, I was waiting for the guys to complete. Then what I'll do, I'll send the link for the survey. Just hold on, just bear with me, guys. 10 seconds. There we go. Okay. You know, when you've got impaired eyes, it takes you forever to figure out where things are. Okay, I sent the requested survey, and then Bruno wants the polls. So
Yeah.
I see that
Sorry,
one.
where did you send the survey? On the group chat? I don't see it
Yes.
there.
Oh, why did I make it private? What, Mr. Patch? It looks like. Okay. There we go.
Oh, there we go.
Yeah.
Fantastic. Cool.
Cool.
Excellent. And then so that's the survey. So this survey is going to help us identify you post this consultation. So this will give us your information, the certain needs, so we know specifically we can isolate your specific needs, and we can actually communicate with you and give you better one-on-one attention. Then the poll specifically, if you guys have just joined us, because I do see that there's a new person, there is a poll that we do need you to complete. That poll is going to allow us to engage with you today. It's going to give us an idea on where you are in your journey so that we know how to approach you. So please, both of those, if you guys can fill it in, I'd really appreciate it. But I don't want to necessarily keep everyone waiting even longer. So I mean, I think for now, let's maybe have a look at the poll. Let's see what the answers were, and anyone that hasn't filled in this linked survey, it should only take you like 1 or 2 minutes. Maybe you can just do it as I'm doing the introduction. We'd really appreciate it.
Okay, cool.
Cool.
Yeah.
Do you have the poll for me?
Yeah, let me just share the result.
Cool.
There we go. I think you are able to see the result.
Perfect. And then just give me user rights to share the screen.
Yeah, I'll make you. Let me do this.
Oh, that's very interesting. That's very cool.
Okay. Cool. You're a host now.
Thank you so much.
Cool.
All right. There, and then share screen. Sorry, 1 second. I want to just take my presentation out of the way. Slideshow from beginning. Great. I'm guessing my screen is going to show up on everyone's monitor very, very shortly. I'm not looking at the Q&A just now, so I'm not going to address the questions just yet. I'm going to maybe leave it for after we just done with the case study to give you guys an example on the type of things that we're looking at. So let's get this started. All right. Now, I don't think we need to go into any further introductions. Most of you already, should already know who we are. This is post that initial consultation or initial discussion when we were trying to introduce each other. In short, Shilly Boy is a tax practitioner. He's a chartered accountant. I'm an attorney that specializes in commercial law, and together it's the perfect fit to try and get this type of trust structures, planning structures, because it both focuses around the legal and the tax aspect of things. So we've touched on it, and I think Shilly Boy has mentioned this previously. So the purpose of this consultation today was, number one, to keep it intimate. We have done numerous webinars through hundreds, if not thousands of people, where we've discussed the different types of vehicles a person can use. We've discussed the whys. Why would a person want to do it? Is it asset protection? Whatever the case is. So we've gone through that in quite a bit of detail. So the intention today wasn't to touch on that again. So I will give a very high level approach to it. But if you guys, so all in all, today's consultation was about asset transfer. And what we mean by asset transfer is there's a presumption that everyone here today has at least one property. If I'm not mistaken, and if I look at the polls, I believe that most people had at least one. Most had 2 to 5, if I'm not mistaken. So that presumption exists. And we're all here today to try to figure out, hold on, but wait, we've bought these properties in our own personal name. What are we going to do? So I'm only going to touch on the whys very, very briefly. So what you see on your screen right now is just the basic vehicles that a person generally uses when getting into property investments, when looking at their structuring. You only have a couple. You've got yourself in your personal capacity, in your own personal name. You've got a trust. You've got a company. I know that a certain gentleman mentioned closed corporations. So now the problem with closed corporations is they no longer actually they're functional. So the existing ones are functional, but no new closed corporations are being incorporated, which basically means that it's being phased out. There's going to come a point where there's going to be no more closed corporations. So for all intents and purposes, we can assume that when I refer to companies, I'm also referring to closed corporations because of the similarities in the way that they operate and the way that they're run. But speaking about the different vehicles doesn't give justice to the investment structure planning, because the reality is the vehicles in themselves are only tools. They're the how, but not the why. Why are we putting things in these vehicles to begin with? And that's the fundamental answer that we've done over and over again in our previous lectures. And the three primary principles when it comes to that is your asset protection, your tax efficiency, and your financing optimization. Now, obviously, because you guys are here today to discuss the asset transfers, I'm not going to go to the same level of detail on these three that I've gone before. So just a quick, just to touch on, just to kind of remind you guys on why we're doing this, why it's important, why it's a proven fact that if you're going to invest in property, that you need to have the right investment structure. So this is beyond question. This is a point that we've proven over and over again. It's a point that's being proved by many other people over and over again. And it's something that anyone can challenge us on. We'd very easily be able to prove it. So uh, the question today is, sure, okay, cool, we're going to get the structure. We just need to figure out how to take stuff that we have at the moment into that structure. Now, why would you want to move it into that structure? Very briefly, your asset protection. You want to protect the assets. You want to keep them away from liabilities. So you don't want yourself and your personal name, your job, anything that you do in your name to impact any of your assets. So we divide these up and we make sure your assets are separate from you. But similarly, we do the asset protection to also protect you from your own assets. Because remember, assets, to run an asset, normally requires some level of operational involvement, operational expenses. So even in with your assets, there are debts that are going to be incurred. So if something ever did happen with those liabilities that are linked to your assets, if you have them ring fenced in a separate company, it won't impact you. So this is a dual relationship. It's reciprocal. You protect that, that protects you, and the distance is what keeps you safe. So that is what you're looking at the moment. And guys, please remember, the companies don't act to in the protection of assets. Strictly speaking, they don't. Why? Yes, it's true. If you buy a property or buy an asset in the company, it's not in your personal name. So that's great. So that means that you create that distance between yourself and the asset. But what you guys are forgetting is that the shares are still in your personal name. So in your personal name, if something goes wrong, those shares are exposed to your creditors. So it creates some distance. It protects you from the liabilities of the company, but it doesn't protect the company from your liabilities. And that's what I mean with the reciprocation. You need to make sure that reciprocally everything is protected. You hold a company property directly in a company, you're only protecting one side of the relationship, not both. So this is why the go-to when it comes to asset protection is to always have a trust, because the trust is the only sorry, I see there's people in the waiting room, so I'm just admitting people. My apologies. So a trust in South Africa is the only vehicle that truly, truly offers asset protection. In the sense, it's because of the way that it's legally structured. And I don't necessarily want to go into too much detail on it, but the assets in the trust don't vest in the trustees if the trust is drafted properly. And the directors, it's not vested in the directors because the directors don't own those assets. So those assets sit perfectly in the middle. and the trustees decide when to give it to the beneficiaries. And at that moment where they're giving it to the beneficiaries, that's the only time it vests, meaning that it's perfectly safe throughout. And this is why we have, sorry, just one moment. I just need to look at the participant list. 1 second. Cool. Sorry about that. I'm also host. Cool. Excellent. So that's the reason why we use the asset, we use the trust as the most optimal vehicle for asset protection. It's because of the legal way that it's been designed. It protects both sides of that relationship. So that's great. So now asset protection, we got covered. Trust is fundamental. You can use companies provided that it's combined with a trust. So at the top level, you need that trust. Whether now you buy properties directly in the trust or in a company that's owned by a trust is completely strategic, and that's more about what we're going to discuss today. And that's the long and short of the asset protection. Tax efficiency. Everyone understands the basic concept of tax efficiency. So today we'll go and we'll discuss things like capital gains, where capital gains stands, how one can actually, when moving properties around, how this gain is calculated. The one reminder that I want to put in everyone's mind is the tax efficiency, the long-term tax efficiency cannot be achieved in your personal name ever, because the reality is you get taxed when you pass away. You pay a hell of a lot of costs. I do actually believe I've got the slide here that shows it. No, not on this presentation. So we did a calculation the one day where we were trying to calculate the amount of money that you would lose upon passing away, and it came to about 42% of your estate. So on a 10 million rand estate, which is pretty normal for a property investor, you could actually lose about 4.2 million rand in costs. That's estate duty at 20%. It was an assumption on capital gains, but a reasonable assumption that came up to 900,000. It's your executor's fees. That's 4% of your estate. It's your transfer costs. It's your transfer duty. And this happens when you pass away with shares in your name or with properties in your name. There's no way around it. It is going to happen if the assets are retained in your personal name. So the reason why we say, guys, get your structuring right is to avoid this long-term, even if it's only for this long-term tax implication. 4.2 million rand out of a 10 million rand estate is a lot of money. Now think about what a trust is going to cost you, which is negligible compared to the 4.2 million rand, which is a conservative figure, because that's on a 10 million rand estate on today's value. Tomorrow's value, 10 years, 20 years down the line, it could be a hell of a lot more, because things like inflation you need to take into account. So what's the value of money then? What's the capital appreciation? You don't know what's going to happen with these properties. Maybe they shoot up in value and you've got a massive capital gain, which is great for you up until the point where you have to pay the tax on it. So think around it from that perspective. Financing efficiency is also the big one. We've sometimes done modeling for clients simply because of financing. Everything else the clients were okay with. But the problem is, once you get a loan in your own name, it's very difficult to get a second, a third, a fourth, a fifth in your name, because the banks look at you, they look at your affordability, and they give you a loan, and now you've got a debit going off your account and a loan that's registered against your name. That impacts your affordability. So the second time you go to the bank, they go, oh, but you've got a big debt and it's in your name. If you buy it in a company, it's the company that has the debt, not you. So yes, you might sign as a surety for that debt, but that doesn't matter, because a surety is not the same as a debtor. A surety is contingent. It means that you will pay if something happens. A debtor is liable today, right now. And those are the primary differences. So these are the reasons why you guys need an investment structure. These are uncontestable. They've been proven over and over. You're welcome to challenge me on it. We've done it a million times. We could do it with our eyes closed. So now what we're going to move on to very quickly is we want to start getting to the case study, because that's the importance of this. So things like this, for example, just kind of build up to what I was saying before. So your asset protection, your tax efficiency, your financing optimization, these are balances that you need to reach. So now when we're speaking about asset protection, we need to decide, how do you want your investment structure to look? Now you've got a couple of properties in your personal name. So I've seen people, for example, I do want to stop sharing my screen so I can quickly check the poll again. So I see people, for example, have 71% have 2 to 5 properties in their personal name. Yeah, 2 to 5 properties in their personal name. 29% has one property in their personal name. So from the looks of it, out of I think it's about 70% of the people that answered this have properties and have it in their personal names. I also see that predominantly most of you are married out of community of property or not married at all. So that's good to hear. And that predominantly out of the 7 answers, 100% of you are intent to reinvest the money. So that's good. I like working with those figures. That makes a lot of sense for me. So let me share my screen again. So now we're sitting with the asset protection question. Now, most of you have the properties in your personal name. Big issue. Asset protection, like I explained to you in the first slide, in your personal name, you lose that reciprocation. So both sides of that relationship are at risk. You're exposing the asset is exposing you, and that's what we're trying to avoid. So you want to try to push up your asset protection. Now you want to be careful. You don't want to just have a trust and have a hell of a lot of companies, each one owning a property, because that sometimes is a little too much asset protection. The problem with something like that is that it's admin intensive, and just because you put one property in each company, the problem with that is it gives asset protection from each property to the other property. So this one won't expose that one, won't expose that one. But the problem that you're going to have with this, as you can see from the slide, is your financing efficiency is going to suffer. Because when a bank looks at you and decides to look at your company and the affordability, it's going to see that your company doesn't have a good income because it only has one single property. So you do kind of want to think how you want to structure it, and you want to pull your properties together. So the guys that have 2 to 5 in your personal name, think about that. Now, 2 to 5 isn't bad because there weren't bigger numbers than that. So when you start looking at 10 plus, that's when I start thinking, you know what, you guys need to divide it up across multiple companies for better asset protection. But 2 to 5, it's still safe to put it all in one company because you want to build up that track record. So you don't want to overdo the asset protection. You want to have it in a trust, but maybe a single company, and then your financing optimization will become better and it will gain a bit of benefit. So the same contrast exists from the other way around. So if you look at the financing optimization right now, it's the flip side of the coin. So if you focus too much, so if you had 10 plus properties and you're shoving them all into one company, you're opening yourself up to risk because now you've got all your eggs in one basket. Fortunately, from the polls, I don't see that being the case here. So I'm not going to spend too much time on this side of things. Tax efficiency, Shilly Boy is going to touch on this in quite some depth. So I'm not going to really deal with it right now. I'm going to move on to the case study to just discuss to just give you context on an example of a situation that we're looking at. So in this particular instance, we were looking at, these were real clients. We just changed the names for the sake of safety or anonymity. So call it John Doe. John Doe and Jane Doe. They were married to each other out of community of property. And they both owned joint properties. So there were a couple that owned individual properties, and there was one particular property that was owned by both of them, right? So that's the scenario that we're playing at. So what we started doing over here is we started looking at recommending to them. So they came to us with an existing portfolio that had no companies, that had no trust, that had nothing of the sort. And they started asking the question, but now what do we do to actually move these things across, for the sake of, protecting all these principles or utilizing all these principles? So what you see over here, so this is when the recommendation came in, and this is the first aspect of it. This deals with asset protection first, and the next aspect we're going to start dealing with, tax efficiency. So the first thing that we looked at was asset protection. We said, look, In your name, not a good idea. It's going to be a problem. So how are we going to fix that? So the first question we asked was, but hold on, before we answer that, we actually need to know, what are you planning on doing with the income that's coming in? And that's why we asked you guys, are you guys reinvesting the money? Because there's two very contrast ways of dealing with income. You either reinvest it or you use it. It's quite simple. Yes, there's a combination of both. So you reinvest a little bit and you use a little bit. But at the end of the day, there's only really two things that you do with it. You put it back or you don't put it back. So on a compounding based strategy, we looked at the clients and we suggested, okay, wait, you know what? The reality here is you've got two individuals, you've got one joint property with them. What we need to start looking at here is possibly creating a trust for them for the sake of asset protection. Now, because you're going to put the money back, ideally what you want to do is you actually want to trade in the company under the trust. Now, why would we want to do this? Reason for that is the company can retain the income at a relatively good tax rate. Why? How does this make sense? So what we're looking at here is you have a trust versus a company. A trust gets taxed at 45% if it retains the funds, whereas a company gets taxed at 28% if it retains the funds. So if you're planning on reinvesting the money into the company so you can buy more properties, it would make logical sense that you'd go with the company that only pays 28% in tax. Because reality is 28%, the 28% you're not declaring dividends, which is now extra tax, you're keeping it, right? In the trust, it would be a problem. But in the distribution-based strategy, it's a completely different story. In distribution, what we're doing there is we're looking at the use of the money, consistent use of the money. And we're asking ourselves then, hold on, wait, but now we want to utilize these funds. We don't want to reinvest it. We want to use it month to month. And a lot of people do this, for example, when they're relying on this income for their own survival or daily needs. Now, sometimes here, what's a very smart option that some people don't think of, and some planners don't want to advise you on, is the reason for this is what a trust does is a trust can own properties and can hold properties in it, for example, or any form of asset in it. And there's a certain principle that a lot of planners and advisors don't really utilize or don't understand how to utilize. And this is a principle that's called the Conduit principle. It's legal. It's a principle in our law. And what this means is when the money goes into the trust, it doesn't stay in the trust and get taxed at 45%, which was the big no-no that we were discussing now. It actually moves directly to the beneficiary and gets taxed in the hands of the beneficiary. Now, if the beneficiary's tax rates are lower than 28%, definitely lower than 45%. If you're looking at distributing to children, for example, or your elderly parents, or whatever the case might be, and your tax rates are quite efficient, this is the perfect structure to have your initial properties in, because this would allow you to utilize the funds. So say you own a property, the person that owns one property, even if the people that own 2 to 5 properties, they own a couple of these properties and they're thinking, and they're using the income, or better yet, they get a salary in every month. And they go and they've got 2 children and they pay the one child's school fees of 2,000 Rand, the other child's school fees of 2,000 Rand, and maybe they support their parents and they help their parents with utilities or rent or whatever the case is. The problem is when you get your salary, you're paying tax on it at your tax rate. And then you're taking whatever you received and you're handing it out to your dependents. What if you didn't have to pay tax on the money that came in? What if the money went directly to your dependents through a trust and your dependents had to pay it at their tax rate? And now then you can tell me, what tax rate does a child have? What tax rate does your dependent parents who probably don't have jobs have? So that's where we start thinking at being able to have a distribution-based strategy that's actually quite efficient for you as an individual. So those are the type of lines that we're thinking across. So when we advise you on moving assets from your personal name to a vehicle, it's not just about move it, come, just get it out the way. It's about why you're moving it. Understand your needs. And this is why we ask the questions. So predominantly all of you here today were speaking to me about reinvesting the money. So presumably all of you here today would go for the compounding based strategy because you guys want to run it in a company, you want to create a business. And what's the upside to this? You're going to get your financing optimization very quickly. You're going to create a business that has great income, and the banks are going to look at it, they're going to love you for it, and they're going to want to throw money at you. And that is the upside to this compounding based strategy. So that's the asset protection side of things. Now we're looking then at, now we start focusing on the tax side. So this is just figures so you guys kind of understand what our approach here was. And this is when we start thinking, but how are we going to move the assets from your personal name into the name of a company or into the name of a trust, or whichever one you guys would want. So just to kind of give you a brief outline of it, you were looking at one individual having 4 properties, the wife having one property, and then together they owned 1 property, right? So in total, you're looking at 6 properties here. Now, what you're going to find interesting here is bad prop 1 and bad prop 2. If you guys can see the top 2 lines, if you look at these figures, you're looking at the person having bought it at 540,000 Rand, having taken out a bond for the full 540, still having 475 outstanding, but the current market value being 419,000. That's a massive loss. That loss is astronomical. It's about 120,000 Rand. That's a very big loss. And you'll see from the next slides, this is when we start discussing this. So you've got these massive losses here. And then on these 2 over here, you've got, over here, there's a couple of gains. So the purchase price was 1,840,000, and then there was a gain. So 1.3, 1.2. So I'm just speaking through this so you guys have context. So 2 really bad properties, 2 really good properties, 1 primary residence, and then the wife's property is okay. So there's nothing to write home about there. It's an all right property. So now the next slide is where Shilly Boy is going to come in, because he's now going to run you through the movement of those properties from the personal estate into the investment structure. Shilly Boy, you there?
Yes, I'm with you. Thank you so much, Bruno. You pretty much covered, and you gave them what do you call? If you don't mind, you can show the whole what do you call
The whole
the slide? Yeah, if you don't mind, please. Okay, guys. Bruno mentioned the scenario where we've got about 6 properties and about 4 properties that were actually in the main person. I think in this case was the husband. They were in their personal name, 4 properties. And then the other one they jointly owned. And then the other one was in the wife's name, personal name. So one of the key things here, when you're moving what you call a property out of your name, there are certain costs that we need to take note of. And one of them is capital gain tax, one of them is transfer duty, one of them is legal fees for transferring, because there's a change of ownership, meaning that we need to go to the deeds office and do some sort of changes, right? Now, before we actually look at how to arrive at capital gain tax, we know that it's going to be the market value of that particular property minus the base cost. So a base cost in a layman English is made up of various components. It's a purchase price, it's improvements that you do beyond acquiring that property. It might be legal fees, it's a transfer duty, and it might be a sales agent that assisted you, commission. So there's quite a huge number of items that one needs to consider to make up this base cost line item. Then once we've got that base cost line item and we've got market value, we're able to estimate what will potentially be a capital gain what do you call capital gain for that particular property. Is Bruno here? Just make me a host because I want to go back to the previous slides. I want to show them something. Bruno?
No worries, I will. I just need to remember how to do that.
Okay. Okay, if you don't mind, then you don't have to make me a host. You can just go back to the previous slide.
No worries.
Okay. Okay, Nonyan is asking a question, who determines the market value? Okay, in this case, remember, and that's a good question because what happens is that because you're going to be moving a property away from your name to a trust, right? Which you happens to be a beneficiary of. So normally in terms of law, tax law, they will see you as they will see a trust as what we call connected person, which it explains in many, so that there's a sort of relation between you and a trust in a form of you being a beneficiary. So you are connected. Now, in that case, SARS will always ask you to bring documents that corroborate the given figure. If you were to say to them, the market value is 500,000, they will say, okay, how do you corroborate that? It might be through using the municipality value. You know, when you've got that, the municipality statement for water and electricity or for the rates, there's always that municipal value. So some people use that, or sometimes you can get a market value for the property through sales estate agents in that area. So you can use that and compare that and determine what is a fair market value for that particular property. That's how you arrive at market value. So now, so when we're looking at this situation here, this individual here, we needed to transfer these 4 properties here, right? Now, his purchase price, remember I said the base costs include purchase price and other additional costs, improvements, legal fees that he might have incurred, right? So now we've got 540 and then versus the market value. In this case, market value is about let's say 420 for argument's sake. 420 minus 540, meaning that we've got about, if my math is right, about 120, right, of a loss. It's what we call, now it means we're arriving at what we call capital loss, right? And then similar with this property, we've got what we call, we'll have a capital loss because the market value is actually less than the base cost, right?
Do you want me to jump to the summary slide that where we summarize those
figures?
figures?
Okay, there's a slide for that. Okay, that's fine. We can do that. Let's go there. Yes. Okay, perfect. There we go. At least, yeah, it shows perfectly here. So if you look at this individually here, so the capital loss, okay, the allowable cost, guys, this column where it says allowable cost is additional costs, as I mentioned, legal fees, improvements that were done in these individual properties. Now, the purchase price plus allowable cost, it gives you what you call base cost, and then minus the market value, then it gives you either capital gain or capital loss. So in this scenario, this gentleman on his personal, the properties that he had on personal name, so he had the capital losses on 2 properties and the capital gain on 2 properties. So now, in this, what we also did in this example to give a scenario, we tax planned his case that in a sense that there's something that we call an annual capital gain exclusion that an individual is allowed every year, right? As an individual, you're allowed about 40,000 of capital gain exclusion, right? So now, what we did then, we tax planned in such a way that we sold one property in January and the other one in March. Remember, your year of assessment ends in the end of February. So the moment it says 1st of March, then it's a new year of assessment in terms of SARS, because remember here, we're looking from a personal point of view. Now, in that case, then we're able to take one property with another one, the one that is making a capital gain. In this case, we use bedprop 1 and then Sky 24, and we minus that 40,000 that he would have allowed to be what you call minus in the capital gain, and then we get what you call aggregate capital gain of 40,000. Then of that, we use the highest income tax brackets, then of about, let me just, in this case, how much this individual was, which tax brackets this individual was
I think
sitting.
we assumed 45.
Okay. It doesn't, the math wouldn't make sense for 45 because it would have to be half of that. So I think maybe was the the lowest bracket, tax brackets here. So yeah, so now what we'll then do with this aggregate capital gain, oh yes, what we did then, okay, because the inclusionary rate of an individual is about 40%, right? So of that 40,000 aggregate capital gain, you said 40%, then we get 16,000 and then multiply by 45 that he would have potentially have to pay. Then it gives you that particular capital gain tax that he would have paid. So by virtue of tax planning it in such a way that we didn't also dispose this holiday flat in the same year as the other one, we saved this guy a lot of money because what we did, we moved the other properties in the following year, right? And then as a result, we will also get additional benefit of that 40,000 in the following year. So if you didn't know how to move this property, you would have probably sold all these properties in the same year and you would have incurred actually even more additional taxes, or you wouldn't even have increased your base costs in a correct manner, like additional these allowable costs that some of you might not even be aware of. And which is what I want to stress out. You need to keep records, guys. Keep records of that you incur on your properties. It's very, very critical because when you dispose that particular property, is going to be deducted. You're going to reduce your capital gain, provided that those costs are actually what we classified as improvement. There's a repair, which is normal repairs. We're just fixing, it might be door handle or something like that, or a broken window. That's a repair and maintenance. But there are certain structural change that can be classified as an improvement. You need to keep all the records for those costs because 10 years down the line, you're going to want to sell that particular property and you might not even have those records. And as a result, you end up overpaying for tax, but just mere of you not having a proper track, what do you call, record keeping. So now, one of the things here that I want to say that it's inevitable, it's around the legal fees. The legal fees, because of change of ownership and has you're going to procure the service of the lawyers like Bruno's my attorney's firm, you can't really bypass that. But what I need also to highlight is that by virtue of this person transferring these properties away, the tax component of it is so minimal compared to the realization of equity, or especially on these two properties here, right? On top of that, if Bruno can, if you don't mind, just to you'll go back and then come back quickly. I just want to show them the equity component that you will realize by virtue of you moving property away from your name. So this individual here will probably realize over close to $1 million just by virtue of moving these properties to the investment structure that we recommended for him. So he would have realized, I mean, paying 7,000 to realize 1 million. So probably most of you guys are sitting on a huge equity that you could be leveraging actually if you were to move your properties away from your personal name actually into an investment structure that we can recommend in your unique customized case. And on top of that, this individual, because there's already, like Bruno said, there's an outstanding bonds here. So this individual, by virtue of them moving these properties away from them, they're actually freeing affordability in their personal names. Because what happens is that by virtue of them canceling bonds in their name, it means they don't have any debt obligation in their personal capacity. Therefore, when we move and we want to refinance these properties in that investment structure, they're only going to stand as surety, right? Then it means we moved that debt component into a company that will potentially be owned by a trust, right? So you effectively realize about a million, and Bruno, you can go to that summarized slide, a million versus about 7,000 and the legal fees of about what, 33,000. That's literally nothing compared to how much you're actually doing. Meaning that this person can actually triple the asset portfolio, because what happens is that with that bond, with that capacity, affordability, this person can actually go to about 4 banks and raise finance, because they don't have any debt obligation. Obviously, disclaimer is that we don't encourage reckless borrowing. So you just need to make sure you also can actually afford to stomach that. But the substance of the case is that this person actually freed up a lot of financing by just a mere of moving their asset. And I can assure you, most of you guys are in the same situation, especially those guys we can see from the poll that you've got more than one property. If you were to move that, you immediately freeing some of the equity that is sitting there. In the interest of time, I think that's pretty much, unless Bruno, there's anything else after this. I remember that after this is not much. It's just reiterating some of the texts which we already covered. And then I would prefer that we take some of the questions. I see that okay, we answered there. Who determines the market value? Slindil is asking, if the company doesn't have the purchasing cost, and as an individual, I want to borrow the company the money, is it better to donate the money to the trust and have the loan be in the trust name, or should I make the loan in my name? What's the better option? Look, to answer your question is, it also depends on if you need that money back, right? And also in how much is that money. Because for instance, you can do 100,000 donation without incurring donation tax, because we also need to bear that in mind. I mean, if you're gonna donate about over 100,000, you need to take into account the fact that you're going to incur donation tax of about 20%. So you can capitalize your trust. It's good to keep what do you call, it's good to have a lot of funds at the trust level. I would prefer that you keep that 100,000 in this case, assuming at the trust level, and then let the trust loan the company. It can raise a commercial and charge an interest loan. I mean, interest, what do you call, charge the interest on that particular loan. And then it would be even nice to sort of extract money out of that company going forward, and then it will generate an interest income on an annual basis, depending on the agreement between the trust and the company. So with that said, thank you so much. I don't know if Bruno have got anything else before we go into the questions. And before we go any, please take note and submit the survey, so that we're able to know your situation and we're able to assist you. I see Nati says, I'm in the middle of a sale with a bond granted.
Sorry, before that, there's one on installment agreements, and
Okay.
then there's one by.
Which one
do you want to take any of them?
Let me see. How would I transfer using installment? Okay, you'll jump on that. I'm in the middle of a sale with bond granted, sale or a purchase, but transfer hasn't happened. Can I still register in a trust? Okay. I think it's best if this person clarify, Nati, because what we need to know is if they already lodged the what do you call this transaction, because it's also important. I mean, if they already lodged at the deeds office, there isn't much we can do. But then if it hasn't been lodged, you can actually go to the transferring attorneys and propose that you want to change the offer to purchase and make it in a trust. But the thing is, it's gonna delay also the registration of the transaction, because a trust is not something that takes a week or so. It takes a while. That's why we always encourage property investors to fix their situation going forward, so that you don't have situations like this. But I'm sure, Nati, we can look at your situation and advise accordingly. That's why it's also important, guys, to fill on that survey, and so that we can be able to reach out to you and be able to assist you on a daily, on an individual capacity. Yeah. Bruno, you want to take the installment sales?
Okay, so just on the last question with Nati. So interestingly enough, the problem is that if you've made the offer to purchase in your own personal name, it causes problems because it's a set purchaser. And the issue with this is there's no playing around. You can't hide yourself as a purchaser. So it's either you or it's not you. And so substituting with a trust now, exactly what Shilly Boy said, you would have to regretfully go speak to the seller, ask the seller to change purchaser, and then you would need to then basically redo all the documents. So for all intents and purposes, you'd still need to reapply for a loan. You need to sign a new offer, reapply for a loan, sign new transfer documents, a whole range of stuff. So sometimes what I do tend to find is the sellers aren't very amenable to this. But that being said, I'd give it a shot. I'd approach and I'd try come up with a solution and see if people are willing, especially if it's at very early stages. Some people might not mind. If it's very late stages, close to lodgement, you unfortunately you are going to struggle. If you bought it in the name of a company, however, different story. Because in the name of a company, what's interesting is the banks ask for who the shareholder is ahead of time, but then they do give a bit of leeway. And if you approach them later and say there was a change of shareholding before registration took place, the banks often don't say anything about it as long as the directors haven't changed. So interestingly enough, there you could say that you were initially the shareholder. Now the trust is the shareholder, you remain a director, and there you could probably pull it off. So it does depend in the entity that you bought it. Then installment sale agreements. Installment sale agreements, there is no difference. So how would transfer using installment sale agreement work? So remember, the problem that we're sitting with is, again, installment sale agreement. If you made the offer in your personal name, what would happen there is this deed would be registered at the deeds office. So again, it depends how far you are. So if it's in the early stages and the attorneys haven't actually registered the agreement, then it's easy because you just sign a new agreement. And remember, the nice thing with installment sales is there's no registration of transfer. So if you've paid, let's say, 5,000 Rand a month for 3 months, it's fine because you sign a new agreement and you just acknowledge that that 5,000 Rand is actually paid by the trust or the company and not you in your personal name. So the actual payment of funds can easily just effectively be allocated to your new trust or your new company. If it's been registered at the deeds office, unfortunately, this will come out at extra expense because you've already spent money lodging at the deeds office. So you then need to cancel that sale, sign a new agreement, lodge that at the deeds office. But if your transferring attorneys are nice enough, they won't necessarily charge you for drafting a new agreement. They will just charge you the registration cost. So you may land up paying something around maybe 5,000 per transaction, somewhere around there. So now you just need to repay that. But trust me, it's a lot better than having a property sit in your personal name because you'd pay a lot more later. So this is actually a cheap way out. Good for you. You bought it in installments. You can probably get out of this relatively unscathed. My properties are owned by a CC. I'm the sole member. Judging from the time, this is going to be our last question. So let's. My properties are owned by a CC. I'm the sole member. For now, the income is reinvested. In a few years, I would like to use the income for personal expenses. I would always also like the option to sell existing and or buy new. I have a trust. Should the trust become the sole member of the CC? If so, at what stage? What are the cost implications? So if memory serves me correct, sure, it must have been years since I've dealt with this. But if memory serves me correct, a trust is actually allowed to be a member of a CC. I'd want to actually verify this because we haven't actually looked at CCs in quite some time. Shilly boy, maybe in the background, if you want to answer Nonyana's question, let me just quickly have a look at that question and then come back on it.
Okay, cool. Where's Nonyani? Okay. So can I buy an asset using a company and later change share ownership to a trust without incurring cost? Mr. Nonyana, yes. Unfortunately, like we showed you on the case study, is that there are certain costs that are inevitable, like legal fees. You are going to incur legal fees mainly because lawyers, you're procuring the services for them to draft documents, lodging with the deeds office, and things like that. So there's no exemption from when it comes to the lawyers. You're going to have to incur. That's a minimum cost that you're going to incur. Now, when it comes to us, where we can assist you is to ensure that we minimize some of them costs like capital gain tax and find a way also around the transfer duty. Those are because those are typically applicable costs when it comes to asset transfer. So it also depends on how high your capital gain tax is, because it gets where it gets. If we see that, okay, the capital gain, it's actually a huge one, we start using things like Section 42, where we sell that property over a number of years, for instance. So now, basically, to answer a question, the minimum cost you're going to incur is around legal fees. And also, because you're going to be, that asset will be owned by a company, you'll be moving the shares. So now the issue with that is that there's a tax called security transfer tax, is any tax on share trading. Provided obviously that is not within the exemptions, you might be liable. It's about 0.25%, if I'm not mistaken, of the value of your shares. And then on top of that, like I said, the transfer duty, because of also the fact that that company will be owning that residential property. So there's a situation where SARS says, they see it as just a transfer of the property, then you might be subjected to the transfer duty if that particular company, that particular property or that is within that company is actually over $1 million. Like, we know that anything less than $1 million, you don't pay transfer duty. So at minimum, you're gonna pay legal fees. That's the minimum cost. So that's why we're saying, going forward, guys, we might be having a situation right now that you guys own properties in a different form, and you're exposed. All I can encourage is, going forward, fix yourself, and then the properties that you're buying from today, make sure that you buy them in a correct investment structure, and then we can take our time in trying to fix the past, especially trying to free you out to ensure that you've got affordability. You want to have as less debts in your personal as possible, because you are the biggest asset that you can leverage to raise more bond, with banks, and building your property portfolio. When Bruno is still looking for that, is there any question, guys? Feel free. I'm gonna start picking up on people if. Oh, you're done.
So just to answer on that, so Shilly boy, you can actually also partially answer this question, because there's been so much legislation change when it comes to this, that that I can't actually even. So there was legislation change that does confirm that a trust can be a member of a CC. So that's been confirmed now, provided that there's none of the beneficiaries of the CC are companies. So it's basically to try and avoid a juristic person running that CC. So that's definitely a plus. So you can do that if you want to do that. The tax implications of CCs are one of those things that we would just now need to double check. But if memory serves me correct, it is still taxed at a flat rate of 28%, if I'm not mistaken. I just can't recall if there's an extra tax like dividends tax, for instance, that normally gets charged. So maybe you can comment on that. So I suppose
Yeah.
the question that we need to answer over here when it comes to this is, if the property is owned by the CC and the trust now becomes a member, then you've got an investment structure very similar to the ones that we discussed. So you've got a trust at the top, a company / CC at the bottom, and you're getting income into the company. So that's the one thing. And at the moment, it's being reinvested. So now the first question we need to look at is the transfer of the members' interests, because the members' interests now, where you're a sole member, are still valued at X amount. So now you need to bear in mind that there is going to be a cost to transfer this member's interest into the trust, because ultimately, if the member's interest has gone from 0 to X, that's a capital gain. So now you need to bear that in mind. These members' interests may come at a cost. If it's a residential property, the transfer of members' interest may also require the payment of transfer duty. So these are two considerations. So this is where Shirley Boy and myself normally come in, and we try to reduce these taxes by finding things like exactly what he explained, increasing base costs, etc., etc. Now, the use of this income for personal expenses, this I'm going to let Shilly Boy answer. So when we're extracting money directly from the company, what is the tax rate of the company, and is there a subsequent type of dividend tax that one needs to look at? The question then went on, I would also like the option to sell existing and or buy new. So that's a given generally. There's a trust. Should the trust become sole member? All right. And if so, at what stage? So basically, you'd want to try and effect everything right now. Cost implications. So from the tax side, I've already explained those are the cost implications. So capital gains and transfer duty are definitely something that might come into place. So now I suppose the only remaining section of that needs to be the tax on the closed corporation. And I think that is going to be our last question. Unfortunately, I need to go. I've got another consultation I need to go to. So Shilly Boy, it's up to you if you want to take one or more questions. But after this one, I need to jump onto my next call.
Yeah, I think, in the interest of that, let's call it a night. And guys, you are more than welcome to reach out to us. That's another thing why we said, please copy the link below with the survey so that we know your situations. All the questions that you have, there's a section where you can put all your questions. And then I think in the next few working days, we can reach out to you and then try to solve your problems. What you need to take out of this is that try to minimize as much cost as possible, and try to minimize your exposure and have less properties in your personal names. And let's have a conversation. How can we fix that? It might not be an overnight thing. It might take a couple of years to fix that, but at least going forward, try to ensure that your structures are actually sound and you're protected and they're efficient, and also in terms of finance efficiency, asset protection, and tax efficiency. And then you'll be able to do wealth preservation. Otherwise,
so Shilly Boy, before you close up, so just maybe just copy and paste the questions that are there. So we still need to get back to Kamlesh on the tax on closed corporations, but that's a very personal question to him because very few people worry about closed corporations. So maybe just remember that one and reach out to him. And then there was another question which we can copy paste and maybe answer. They're just asking about the figures on the spreadsheet that we put up and what they represent. So that's also something that you can maybe just copy paste and reach out to them tomorrow or so, just with an answer.
I did that, and then also I copied the questions, guys. And when we meet, then obviously we'll revisit those questions. It will be in the next week, so, and then we can have that conversation. I think that's it. Okay, cool. From me, thank you so much for joining us, and I'm looking forward to what do you call? Okay, there's something say tax rate. Okay, I think Patel will speak. Okay, thank you so much, guys. Be on the lookout to some of the sessions that we normally have internally. Otherwise, you can join us for our roundtable that are open to the public. And then, yeah, be on a lookout also for roundtable. And then otherwise, thank you so much and take care of yourself, guys.
Excellent. Thanks. Bye.
Cheers.